Right now, the global crypto space is experiencing an absolute earthquake. Bitcoin has taken a massive nosedive, plunging violently down to the $59,000 level. This is the lowest price point we have witnessed in nearly 2 years, and it has sent absolute shockwaves of panic through retail investors all over the globe. Billions of dollars in leverage long positions have been wiped off the map in a matter of hours. But the real drama isn't just the price chart. A massive high stakes public feud has erupted on social media. Financial commentator Jim Cramer publicly pointed his finger and stated that Michael Saylor completely murdered Bitcoin. This isn't just a regular internet argument. This is a battle over the entire narrative of why the market is bleeding. So in this video, we are dissecting Saylor's unexpected response, looking at the hidden blockchain data revealed by on-chain experts, and figuring out who is actually responsible for this market flush. Alright, let's start with our very first question about why did Jim Cramer claim that Michael Saylor murdered Bitcoin? To truly understand this chaos, we have to look at the sheer scale of the drop. Bitcoin did not just slide down, it shattered right through the $60,000 psychological floor during a brutal trading session. We are talking about a single day drop of over 7%, compounding a massive 20% loss over just a single week. When the blood in the streets was at its peak, Jim Cramer took to his public platform to blame the executive chairman of MicroStrategy, claiming his aggressive strategies and recent actions are what ultimately killed the asset's momentum. In my opinion, blaming one single corporate executive for a systemic global market sell-off is a classic case of mainstream media sensationalism. The financial media loves a scapegoat because pointing at one person is much easier for the public to digest than explaining complex macroeconomic shifts. Saylor didn't destroy the market. In fact, his response to Cramer was brilliant and incredibly calm. He replied, "It's just a flesh wound, Jim." Alright? To me, that shows the exact type of unwavering confidence that long-term holders need to see right now. It reminds everyone that a drop to $59,000, while painful, is just part of the volatile journey of digital assets. Right? Are corporate moves or hidden whale outflow driving this crash? As the blame game escalated, the CEO of the crypto quant Ki-Young Ju stepped into the arena to bring actual data to the conversation. He fiercely defended the corporate accumulation strategy and pointed out a massive flaw in the mainstream media narrative. The media focused heavily on the fact that MicroStrategy sold a tiny, minuscule fraction of their holdings, just 32 Bitcoin. Meanwhile, the actual on-chain data shows something completely different happening in the background. In my opinion, this is exactly why I always tell people to ignore the corporate headlines and look at what the actual blockchain is doing. The data doesn't lie. Ki-Young Ju revealed that early. Original investors, the legendary OG whales, have quietly dumped a staggering 1.24 million Bitcoin into the market over the past 2 years. Alright? When you compare 1.24 million Bitcoin being sold by old school whales to a tiny 32 Bitcoin adjustment from a corporate treasury, it becomes completely ridiculous to blame the corporation. So my perspective is that this massive early investors are taking profits at scale, using the massive liquidity provided by Wall Street institutional ETFs to exit their positions. That is the real structural selling pressure, not a minor corporate rebalancing. So, how much credit does the institutional demand safely deserve? An analysis provided by the CryptoQuant CEO went even deeper, forcing the market to look at what would have happened to the price if large-scale institutions hadn't been here over the last 24 months. The aggressive buying from corporate treasuries and spot ETFs acted like a massive sponge, absorbing an unprecedented amount of supply that was flooded into the open market by these early whales. All right. As a market observer, I strongly agree with the assessment that Bitcoin's price floor would be significantly lower right now if these corporate buyers hadn't stepped up to the plate. Think about the sheer math of it. Without that institutional wall of demand absorbing those millions of dump coins, a $59,000 Bitcoin would look like a luxury right now. We could easily be staring at a much deeper, multi-year bear market. The market needs to give these large buyers more credit for stabilizing the asset class, rather than treating them like the villains of the story whenever a temporary correction happens. Now, is the brutal Bitcoin debt spiral narrative completely overdone? Whenever Bitcoin drops by 27% in a week, the mainstream financial media immediately dusts off their favorite old headline, the crypto debt spiral. They try to convince everyday retail investors that the asset is going to zero and that the entire experiment has completely failed. Citigroup analysts even jumped into the mix, publishing a report that attributed the entire crash to massive systemic capital outflows from the newly launched spot Bitcoin ETFs. Right? In my opinion, I am completely convinced that this death spiral narrative is a tired, recycled fiction. Every single cycle we see the exact same dramatic headlines designed to shake weak hands out of their positions. The Citigroup report proves that this is a standard liquidity cycle driven by institutional fund flows, not a fundamental flaw in the technology itself. The ETF outflows simply mean that big money is temporarily moving into cash or bonds due to global macroeconomic fears. It is an economic rotation, not a murder. The fundamental network health, the hash rate, and the global adoption metrics are still completely intact. Alright, overall, we are witnessing a massive psychological war for the future of the digital asset market. On one side, you have the sensationalist mainstream media figures claiming the asset class has been destroyed by its own biggest promoters. On the other side, you have hard, unyielding on-chain data proving that this is a natural macroeconomic contraction exacerbated by early whale profit taking. Michael Saylor is currently no flawless hero, but claiming he murdered that the market is factually and mathematically incorrect from every possible angle. The real lesson here for any serious market observer is to separate the loud, emotional noise of television commentators from the cold, data-driven reality of the blockchain. The market has taken a hit. The $59,000 level is testing everyone's patience, but the structural foundations built over the last 2 years are far from broken. So we need to keep an eye on the data, ignoring the talking heads, and don't let temporary scratch convince you that the asset is dead. And this finally ends our video. Thank you very much for watching and see you on the next one. Or you might just as well check this next recommended video right here.